All right, good morning. This is your first half of 2026 market trends update. So DMAR, the Denver Metro Association of Realtors, released their July numbers, and this is a little late because of the 4th of July, but I wanted to break this down in a very comprehensive sort of way, and some actionable takeaways for both buyers and sellers and what it means specifically for you as you look to enter the market or list a property, or how we can project out 6 to 12 months, even though that's impossible, but still we can take the data that we have right now and apply it to what you're trying to accomplish in your goals. By the way, I'm Jason Dalby. I'm the team lead with the Denver group here at REalBroker in the Denver metro area. We are a high performing real estate team. If you have questions, if you want to book a free, no obligation consultation, talk about your goals, talk about your real estate wishes and needs, then please reach out. That's what we do. We book people all the time and we walk them through whether it's action now or a year from now. So let us know how we can help. It's what we do. Okay, so here is the DMAR report. It's 26 pages. I'm not going to go through every single page. I'm going to pull out what I think is the most important. If you want this report, it's going to live in our blog on our website, denvergroup.re.com. Let us know what questions you have about specific metrics that make sense to you. But we're just going to focus on, like I said, some of the ones that we think are the most impactful data sources or data specifics here. So, all right, so let's jump in. So median close price, 616,000. That is up just 0.16% from last month. It's up 1% year over year. So that is essentially flat. It's not crashing. It's not surging. The market has found some sort of an equilibrium. Closed homes, just over 3,900. That's down 6.62% month over month. So fewer transactions, but prices held firm. So months of inventory, 3.25% months of inventory. That's up 6.2% from May. So more homes to choose from than last year. And what months of inventory means is if no new inventory came onto the market, the demand for those properties that are currently existing would sell out in 3.25% months, or 3.25 months. A balanced market, just for reference, is 6% months of 6 months of inventory. Okay, so that is where buyers and sellers are on equal footing. So in terms of months of inventory, this is still very much a seller's market, although we're not really seeing that in the day-to-day complexities of transactions. All right, median days in the MLS, 18 days. That's up a lot from May, 28.57% from May. So homes are taking longer to get an offer. So active listings, we're at 12,744. That's up 3.96%. New listings, 5,700, that's actually down 4%, and sellers are hesitating, okay? So for buyers, this is more choices than 2021. It's not a flood of inventory, though, that the headlines might suggest. We've got 12,744 listings, is still well below the historical June average of 15,098 listings. For sellers, your home is not flying off the shelf in 4 days. We've known that for a long time. But when the right buyer shows up, you're still getting 99 cents on the dollar. So preparation matters more than ever. We're going to dive into that here and talk about some cautionary tales. Okay. So we're going to move on to this slide right here. This is the full market overview. This is probably the most important page in the entire report. So detached single family homes right here. We've got a closed median price of $670,000. That's up 1.5% year over year. It's healthy. Attached, different story, $391,000. That is down 2% year over year. So that is a soft market, right? It's the same metro, it's the same month. Two different products, opposite directions. All right. That is the entire story of Denver market right now. Detached active listings are down 14%. So we're talking less supply, but still holding prices. Attached active listings are up 2.3% year over year. Days in days, attached is 34 days. It's more than double. Buyers are choosing single family more often. Again, closed to list price detached, you're at 99%, which is a very strong number. Attached is still at 98.5%. So both still strong, but the gap is widening. So when you see a headline that says Denver home values are down, you need to ask which product type they actually mean. So those are two very different markets. So for buyers, if you are shopping for a condo or townhome right now, you have more leverage than you've ever had in our market. There are still cautionary tales regarding that type of product in terms of HOA fees and the insurance required for those, but still, you've got leverage. For sellers, like if you own a single family home, your position is stronger than the headlines would absolutely suggest. If you own a condo, condition and pricing strategy are everything. All right, so let's jump down here. I thought this was an interesting one. So this is the expert opinion of DMAR Market Trends Committee Chair Amanda Snitker. And I'm going to read this quote verbatim. So, quote, "A widening gap is opened between truly move-in ready properties and those carrying deferred maintenance. Condition has quietly become the currency that matters most." All right. What does that mean? That means when your home hits the market, it must be dialed. It is the one of a few controllables that a seller has, right? We can come onto the market at a certain price. We can choose the price. We can choose when we come onto the market, and we can choose the condition in which we present this to the market. Okay. Everything else is relatively uncontrollable. So you must have a well-presented home. And if you have questions about how we strategize with sellers to deliver a well-presented home, please reach out. Again, we know this. We know it's in your best interest to do this, and so we want to deliver that to you. So again, I can't express that enough. So showings data, this is a pretty shocking number. So May 2021, Denver listings averaged 14.2 showings per month. Okay. That was May 2021, 5 years ago. In May 2026, just 4.7 showings per month. That's a drop of nearly 2/3 in 5 years. So fewer showings means the first 14 days mean more than anything. If pricing and presentation don't hit, then the home will sit. All right. And a home that sits loses leverage. So there is a nuance though. The close price to list held at 99%. So there's a lot of interesting takeaways from this data. Her exact words: buyers appear willing to wait for the right home rather than settle and negotiate later. So buyers are picky and patient. When they find the right home, they will pay for it. When they don't, they just move on, right? And it makes perfect sense. When it costs more to borrow right now, the buyer does not want to look at a home as a project where they have to invest more money into it. Otherwise, they're going to account for that, right? When in the past, number of years, they didn't. They just bought it. Right now, it's got to be perfect. They don't want to invest more into it when money is more expensive. So appreciation alone is no longer doing the heavy lifting for sellers. Condition is the clearest lever left on the table. All right. So what does all this mean for buyers? If you're touring homes right now, you are in the driver's seat on anything that isn't turnkey, okay? But on the move in ready properties in desirable areas, move decisively, make the decision and go for it, because you may find yourself in a competitive offer situation when you did not need to be. So sellers, the market is not going to bail you out with appreciation the way that it did 5-6 years ago. So the work you do before listing your home, paint, landscaping, declutter, small repairs, that's going to pay you more. That's going to pay you back more than the cost of that. Okay. All right, let's see. We're going to jump down here to a 10-year price chart. So again, if you want any of these slides that I'm skipping over, by all means, it will be available to you. This is, again, the 10-year residential median and average closed price. So the starting point median in June 2017, way back here, median's the bottom line, average is the top line, is $380,000 to $400,000. Okay. June 2026, we've got a $616,000 median. That's roughly 55 to 60% appreciation over 9 years through a pandemic, through historic rate spikes, through the post 2022 correction. Okay. This is COVID right here. This spike. This was an anomaly. This is not the baseline. And then you see a pullback here for 2022. So the peak was real, but modest in the context of, honestly, this entire full chart. So where we sit today, 616,000 is right back in line with the long-term trend. So again, more of a normalization than a collapse. Average close price is just shy of 750,000. So this is showing that the luxury segment is pulling averages up, and that's why we tend to reference median price, not average. So if you bought in 2017 at the Denver median, your home has appreciated roughly $216,000 to $236,000 in value. So that's very real equity in a relatively short amount of time. So this is a very powerful argument against waiting for prices to drop, specifically to buyers. So every market dip on this chart was followed by a recovery and a subsequent new high. And for sellers, your equity cushion. So if you've owned for 5 or more years, especially through COVID, your equity cushion is very real and substantial. So even accounting for post 2022 correction. So that sort of context matters. All right. So let's jump down to a 1-year price snapshot. All right. So we've got residential median, average close price, 1-year snapshot. Same data, tighter zoom, every data point, same data, but just a tighter zoom. Okay, so June 2025, median, right here, again, median's the lower number, 610,000. June 2026, 616,000, $6,000 gain, flat but positive. The bottom of the recent range, 568,000 in January 2026. That is a seasonal low. From January's low to June 616 is a $47,000 recovery in 6 months. So the market moved upward for the first half of this year. The average close price shows a little bit more volatility. So peaks at 741,000 in June and 747,000 in June 2026. So the average shows a little bit more volatility. So this is June 2025 of 741,000, again 747,000 in June, but a little bit more volatility within that year. So luxury transactions are moving this number up fairly substantially. So again, prices are not in a free fall. They dipped seasonally in winter, recovered through spring and early part of summer, and that's what they historically do in Denver. For buyers, if you've been waiting for a price drop to buy, this chart shows you what 12 months of waiting looked like. January buyers at 568 median are already up in a meaningfully sort of way. And for sellers, month-to-month stability confirms your home held its value through the first half of 2026. So that narrative, the narrative that Denver prices are collapsing, does not really match this data. Okay, we're going to jump down into median days in the MLS, and this is something that sellers and buyers should really pay attention to. So let's first look at the left side of this chart, 2017 through 2018. 19, median days running 10 to 25 days. That's a very normal market. Then 2022, the floor absolutely drops. Detached median hits near zero, homes going in hours, not in days. And now this is where we're at. Detached is 14 days on market, attached is 34 days, and trending back towards pre-pandemic norms. So the detached 14 median days in June is up 27.7% from May's 11 days. So the trend is moving up. Attached 34 median days in June, up 17% from May's 9 days, still rising. So as we zoom out, attached hits nearly 60 days at its peak, and we've come back down from there. So attached is actually improving from last year. There are some critical nuances, and these are medians. So again, well-priced turnkey homes are still going in 7 to 10 days. Overpriced or under-prepared homes are pulling the average up to 14 and 34 days. So if your home is sitting beyond 21 to 30 days without an offer, something is wrong. It's either price, presentation, or honestly, probably both. So for buyers, more days on market means more time to do your research, get inspections done properly, make a thoughtful offer. You don't need to feel rushed about it. When you find the right turnkey home in a competitive price range, the data is going to tell you to act. And for sellers, 18 days is the median. This is not your ceiling. A well-prepared, well-priced home in a desirable neighborhood is still moving in under 2 weeks. The median is being pulled up by the homes that aren't ready. Okay, let's keep cruising here. We're going to go to, residential. So this is a long view of active listings and closed sales from 2008 to 2026. All right, this is a chart you can definitely save and share. It answers a lot of his Denver crashing question better than really any stat. So if you look at the far left, 2008, obviously active listings peaked at over 26,000 listings. So that was the foreclosure crisis. Homes just weren't selling. The market was truly, genuinely distressed. And then let's move on to the right side, 2021, listings cratered to about 1,200. So that was, again, pandemic frenzy. So almost no real data there. I mean, there was, but that was such an anomaly. It's almost like that has to be excused. And where we're at right now, 12,744 active listings. So we are right in the middle of the historical range. All right, the orange line is closed sales, and they've been remarkably consistent, roughly 3,000 to 5,000 closings per month throughout most of this cycle. So the demand for the homes is not collapsing. This historical average for June active listings goes back to 1985, 15,098. We're at 12,744, still 16% below the average. So this does not feel like a market in crisis. This feels like a market normalizing after a very unprecedented 18 months of frenzy and uncertainty. So for buyers, Denver's housing market has absorbed the 2008 crash, pandemic, and the sharpest rate increase in 40 years, which has just given us in this profession a lot of different headaches. But there is a long arc of this market is consistently rewarded buyers who got in and held on. That's the thing. You do not want to buy and sell, or you will get caught. For sellers who have held for a while, you do have a market, you do have equity cushion that most markets don't. So the correction off the 2022 peak has been modest, single digits for most detached homeowners. And this chart is specifically showing why. All right, let's keep going on. We are going to skip this. Again, if you want it, you know where to find it. Go to our website. All right, so market by price range. This is going to be where a lot of leverage lives, okay? This is actionable data. We're going to take this a little bit slower than normal. So detached inventory by price range, okay? This is it right here, all right? So you can see we break it down into about $200,000 increments, a little bit more as it gets a little bit higher. So detached inventory by price range, okay? So this is months of inventory that you can see here. All right. 300 to 500,000 is 2.45% of inventory right here. All right. 500 to 750,000 right here is 2.5, and we go up 2.71, 2.9, 2.49, where it drops in this sort of $1 to $2 million range, and then it spikes again as you get into $2 million or more, which makes sense. There's just fewer buyers in the market for those types of properties. So everything under 1.5 million detaches under 3 months of inventory. We talked about that. That is a seller's market by definition. And again, let's look at the 2 million and over, 4.63 months. So this is where buyers start to have a little bit more leverage even on these detached properties. All right. And so now let's flip the script and jump into the attached properties. Okay. 300,000, you've got nearly 7 months of inventory. That is very much a buyer's market. Attached, you're at 4.76 and 4.71 for 500 to 750,000. Again, that is historically a seller's market, even though it doesn't feel that way in the market activity that we see. So attached 1 million, you've got 7 months. Basically, attached over 1 million, you've got anywhere from 7 to 11 months. Actually, technically, we've got a 5-month here. Not a ton of transactions. This is the thing. There's just not a whole lot of data, so it's a smaller sample size. So if you are buying detached under $1.5 million, you are in a seller leaning market. If you are buying attached in any price range, you have a lot of room to negotiate. For buyers, this tells you exactly where your leverage is and where it isn't. Under 3 months of inventory on detached is still going to be competitive. Over 4.5 months on attached, you're going to have to negotiate hard. For sellers, if you're a detached seller from $300 to $1.5 million range, your home is the most demanded segment of the market. Price it right, present it well, and you should be rewarded for your efforts. All right, let's then look at number 16. We'll go down into, let's focus in on some of the luxury here. So $1 million plus has sort of its own story that we do not want to ignore. So a lot of people assume that Denver luxury is struggling. The data, I'd say, is a little bit more nuanced. So year to date, 2026, we got 2,973 homes that have closed at $1 million or more. That's 14% of all Denver metro sales. So more than 1 in 7 transactions. Year-to-date closings of $1 million are up 3.12% versus 2025 and up 10% versus 2024. So the luxury market is growing in transaction volume year over year. All right, so for buyers, if you've been eyeing luxury properties, detached above $1 million or attached luxury, June data shows improving velocity at the attached tier and steady demand at the detached. So the window of relative buyer leverage at the very top of the market is also real. Again, cautionary tales with attached. If you have questions about it, let us know. But the HOA and insurance component of the attached properties is a bit of a challenge. We can walk you through that. So for sellers, if you are considering selling a $1 million home plus home, the market is way more active than many sellers realize. So 2,900 closings year to date is a legitimate pool of buyers in the marketplace, but your pricing needs to reflect 2026, not 2022. So the buyers at this level are sophisticated and patient. All right, so have some just general takeaways. We'll just cruise up here. So Denver is not one market right now. It's basically two. You've got detached, single family, stable, and you've got condos and townhomes that are softer. Condition of your home when you go to sell it is the new appreciation, okay? The market is not bailing sellers out anymore. The homes that are winning are the ones that show well. Inventory is up from pandemic lows. we're still below the historical average. So this is not an oversupplied market. If you are a buyer, your leverage is real in very specific segments: attached homes, fixer-uppers, luxury condos, 2 million plus, detached. So on move-in ready, detached under $1.5 million homes, you still may be competing. All right, so that is a wrap on the June 2026 market update. If you want to go deeper, visit our website, denvergroup.re.com. We've got a blog on there where, again, we break it down, or you can access the full report. If you have specific questions about your situation, please reach out. There is no obligation. We will just talk you through your situation and see what makes sense for you. So I'm Jason, team lead with the Denver Group. We are here to help. We want to be your resource and guide for all things Denver real estate. Thanks for watching, and make sure to follow for more Denver.